And my deep feeling here is that ideas are cheap and execution is the hard part. And so you should feel very comfortable talking to anyone about any of your ideas because the hard part is actually going and executing against it.
Welcome to Money Moves, the show about raising money, making great investments, and building venture scale businesses. I'm Neil Devani, your host and the founder of Necessary Ventures, a firm investing in what the world needs. Each week, we'll talk to folks who have raised anywhere from $10 million up to billions of dollars. We'll learn how they return multiples of 10x to 100x or more to their investors. We dive into their stories, uncovering what worked and what didn't, learning from real experiences to understand the journeys of raising capital and rapidly scaling a business. Money Moves isn't just for those already in the game. It's also for anyone interested in the mechanics of startups and venture capital. Whether you want to raise money, make better investments, or just understand how it all works, Money Moves gives you the insights and advice you need to succeed. So join us each week and hear from those who've been through it all and learn from their journeys. This week, we're talking to my good friend Mitch Lee, co-founder and CEO of Arc Boats. Mitch has raised over $100 million to electrify watercraft, taking Tesla to the waves. Joining me as co-host is our friend Rob Ryan, who co-founded and sold Dynasty after working with Mitch and me at Clinkle years ago. Mitch and Rob, thank you for being here with me. To kick things off, let's just talk about our first fundraising experiences. So, Rob, obviously you had one that Mitch and I were a part of. Mitch, I know you had one as well before your current company. So when was the first time both of you each raised capital?
For me, it was when we started Penny, which is a personal finance app that actually spun out of the company that Clinkle, that I think Rob's first experience came with. So I'll punt over to you and you get to field this first.
Yeah. Clinkle, if you weren't around 12 years ago, was a payments company that wanted to compete with Venmo. And we started in our senior year at Stanford, and it's really easy to raise money. So that summer, we raised from StartX, which is Stanford's incubator program. We got some money from Sand Hill Road, like $50,000, and we prototyped. And the goal at the time was to get one of those early seed stage alpha prototypes out there. It was payments over ultrasound. It just so happened that Peter Thiel was teaching a class on startups at the time. And it just so happened that I had become a TA. And he told us, we have one ticket to talk to him, not two. You can bring me an idea one time to this one secret email. So the class wraps up, and the founder I've been working with, Mr. Duplan, was very excited about where we're at. He's thinking it's time, we should call the golden ticket. So we drive to Peter's office, Clarion Capital, in Presidio. We're late by 3 minutes, which I'll never forget. And Peter had a 1 p.m. slot for us. He had a 2 p.m. lunch. He ended up canceling that 2 p.m. lunch. He was so excited. Our ultrasound demo looked pretty sexy. It was fake, but it looked amazing. And he got really excited about recovering from his Square bet, squaring off against things like Apple Pay, deploying wireless payments to all phones everywhere instantly. So after Peter, other seed stage people started rolling in, and in the end, it was a little over $30 million that we raised.
Did he commit after one meeting?
Yeah, he committed there.
Did you guys agree on a check size in that meeting?
Yes. Interestingly, probably the most thoughtful strategy I've ever seen for seed stage. He was capped. All of the early angels for Clinkle were capped at $250K, which is just enough that you are actually helping, but it's not enough that if you lose it, you freak out. So a lot of these people chomping at the bit could make a decision very quickly. Yes, you could have $250K today. I don't need to talk to the board. I have an option to talk to you later. This is just a convertible note. And no one has majority share, so it's not like they can form a cartel, and they don't even know who each other are.
So you guys dictated the cap to him. It wasn't like his max was 250.
Mr. Duplan, cool as a cucumber, just dropped the ask and told him it was capped.
What do you think was the moment where he decided he wanted to invest?
The demo. So the demo, you have to picture this, unfortunately, software is 12 years old now. It's an iPad, and the user on their iPhone swipes the payment up away from them. So it slides from their phone, and then the animation continues in a sort of physical skeuomorphic way onto the iPad and slides into a slot. So what you're seeing as an investor is there's two founders. One slides money off of their phone, and instantaneously the money slides into another phone. This is the height of the physical metaphor controlling mobile UI. And it had a sort of simplicity to it where you really begin to question, have I just seen 10 years ahead of my time? And is this the one meeting where if I don't buy in, I'm going to kick myself for the next 20 years? This is the moment. I think that completely sold him.
So
I remember that demo, Mitch. I'm sure you saw that early on.
I remember that because I remember getting that demo when I was considering an offer with Clinkle. My reaction was slightly different, but I'm curious on the 250 cap because we
Yep.
Clinkle raised $30 million. So, I mean, was it really 100 plus investors?
Yeah, I mean, I think it's possible that Lucas raised the cap in secret for some other people who came in. Like I know that NFL player came in. I'm sure as the party round continued, the temptation to accept more money
Yeah.
probably increased, and he could use the previous people, whether they were Richard Branson or Peter Thiel, as marketing for the followers, people we might call dumb money.
Yeah, that was really the definition of a party round. It's just a lot of people that accumulated together into a massive round. I mean, 25, I think I remember 25 million when I was looking at joining. It was in all the news, and that was a massive round back then.
It
I think at
was.
some point I heard it was the biggest seed round.
It may have been supplanted, but it was at that time. And
Yeah.
it was 2011. The market was great, and you had 12 people dropping out of Stanford together. The stars were right. Generally, the correlational factors, if Peter Thiel's in, if this thing has already jumped, from trying to raise 500,000 to raising 10 million, what is the final valuation? We don't actually know. Payments
Yeah.
is huge. Those questions made it easy to fool people, but certainly take advantage of a good fundraising environment.
I think Lucas
also
also
think
had a great like infinite upside story, right? He was very good at the like, well, we'll do this, and then we'll do this, and then we'll do this, and then we're $1 trillion company. And he said it with such a straight face, with such a like conviction in what he was saying, as if it was no big deal, that it added some credibility.
Yeah.
Yeah.
I think one of the downsides is that you set expectations incredibly high.
Yeah.
I mean, expectations are proportional to capital raised and the valuation that you raise at. And that's a hard thing to live up to. And I think the company struggled to go deliver against how high we set the expectations right out of the gate.
I want to go into what you thought about the demo, Mitch, and why, Rob, you thought that was so impactful. Because I remember seeing it and thinking like, this looks so cool, but also why do I need to see the dollar bill move off
Sure.
the screen and onto the screen when it could just be like a number change or a push notification?
For me, I was just confused because I don't know, the internet existed then, and I was like, can you just do this over the internet? Like, did you need it didn't sink in of, hey, this demo is meant to showcase that this actually happened via sound waves.
Yeah.
Like I
Yeah.
missed that key component. I was like, you swiped up on this screen and it went down on another screen, and like I've seen the internet work before.
I think you're both right, especially for our generation. That ended up winning. Venmo does not need a physical
Yeah.
metaphor. It's a form with a button. There's one field. It's relatively simple, and that is the dominant model for some other reasons too. But they won that game, so I think the demo is not.
Yeah, I didn't view Clinkle as a Venmo competitor so much as we pivoted into that, but I viewed it more as an Apple Pay and Google Pay competitor,
Yeah,
where you actually kind of do want that local
personal
authentication. Yeah.
Yeah, exactly. I think it was powerful mostly for an older generation, people for whom physical metaphors really explained how the system worked. And so you start hearing this palaver about, oh, it's ultrasound. The merchant is at an iPad. They type in the amount, and then the check appears for payment on the nearest phone. And if you're trying, let's imagine you're in your 40s, your 50s, your 60s, you're trying to keep up with how the valley changes every 5 or 10 years, you know that there's huge upside if you can just get into the right 1 out of 1,000 companies. Having a clear story for how a merchant goes from I only accept credit card payments to all phones, not just iPhones, not just, the newest phone, but all phones that have microphones suddenly can accept wireless payments. That was powerful. And I think the physical moment made them believe the money is actually there. And I know that doesn't make any sense. And of course, I'm a biased participant, but it did seem like he was captured by the idea that he no longer needed to support Apple Pay or Square.
To be clear, I think the pitch was really compelling. It was more the demo that landed a little flat for me, but the pitch still made a ton of sense that you
Yeah.
could do this without special hardware on phones. It's like the adoption on the merchant side is really easy because it's an app you download. Like that sort of thing
You guys remember at
was
this
incredibly
time,
compelling.
there's this Square's super cool piece of hardware. Honestly, one of the coolest plays I've ever seen. The headphone jack had a
Yeah.
little tiny credit card reader, and it was the size of like two thumbnails together, and it was just enough to read the magnetic stripe. And even with that cheap piece of hardware, probably whatever, $12 a material, $15 a material, it's hard to scale because you need to get each merchant to sign up, to give their personal identifiable information, to pass the know your customer check, to order this piece of hardware. That's going to come in the mail in 3 to 5 days. So there's all these steps, and you have to train the humans, right, on how to do the swipe, and sometimes it breaks and blah, blah, blah. The fantasy, right, was that software could replace hardware. And I think that's what accelerates a lot of these software companies. But when people finally think, oh, we can let go of the cash register and we'll just have an iPad, however that will work, you'll figure it out.
There was something magical about the combination, even if they weren't linked. And I want to, before we go over to your first fundraising experience, Mitch, I want to kind of get your guys' thoughts on like, for someone who's listening to this and they're building their first demo, or they're building a demo in align with their first pitch, it seems like there's something that was visually captivating about the skeuomorphism of a dollar moving across both screens. And that is its own independent attention, captivating piece, and combined with the narrative of any device can pay any device in a secured way without a connection to the internet. And one account will be debited, one will be credited, and they can reconcile independently with a centralized system. That is something that we're still kind of seeing like kicking around as an idea in crypto and ledgers and things like that.
I think the part that I would highlight is less the skeuomorphism and more the polish.
Yeah.
It was less about like this looks like a wallet and more like this looks real. Like
Yeah.
it looks like it's high quality, which it was. I mean, we had a world-class design team and engineering team like bringing it to life. And I think that paired with the story is what made that so compelling. You tell this story and then you show the demo and it's looks so nice and polished and it kind of works and it's easier to get wrapped up in that story.
I think great demos are often phrased as stories. They're not a feature tour. That's the classic mistake. You ground the problem, you talk about a character, someone they can relate to, and you move them through this story in which they have to solve their problem. Your product comes in and it has at least one of these magic moments where they get a glimpse into how easy something could be, how effortless that step was. And it might include very polished visual design. You might go as far as to use sound design, animation design. My honest advice for someone stuck in this quandary is you can Wizard of Oz it. Things that can go wrong will go wrong. It's okay to fake a little bit. You can't run an entire company that way. But if you have a very important demo before a live audience, a billionaire is sitting in front of you, and your engineering team offers you two choices, we can have the live demo with all of its warts, or you can have a sanitized version that I guarantee will work, but is closer to a recording of how it would work. My advice for founders is take B, because A usually fails.
The red pill.
What do you think, Mitch? You agree with that? Because I do feel like there's like, credibility and being trustworthy does also really matter a lot, right? If you
Yes,
come
it
across
does.
as, contrived in your storytelling and
100%.
showing like a looks like but doesn't work like kind of demo, that can also fall flat.
Yeah, there have been some companies that have gotten quite a bit of heat for this. Cars rolling downhill rather than driving.
Right.
Yeah.
In a sense, this reflects the difference between design and engineering. Design is willing to fudge in order to get the next step done, but engineering, especially engineering founders, are responsible for the car driving for real, not just rolling downhill.
I think it comes down to trust, that you don't want to invalidate or destroy trust in the process. And so if you say something like, look, I want to demo this self-driving car, and you do it on a controlled course in controlled environment, and you show that, hey, it can get to point A to point B, but it's clear that it's a controlled environment, that seems pretty acceptable to me. If you say, look how awesome this car is, and roll it down a hill,
Right.
that's can ruin trust.
Yeah. Especially when your cover afterwards is like, I never said that it was working on its own. That was your assumption, right? That's
Right,
not
right.
gonna hold water.
Yeah. I think the demos are meant, well, one of my takeaways is you really want people to extrapolate a story for you. You kind of want to tell the start of the story and have that person independently reach the like, here's how it can evolve from there. And a demo can kind of help build some momentum towards that end. But it all comes down to storytelling. And
So with Clinkle, right? It was like it was a great demo, but it was also a bunch of kids who were very smart coming out of Stanford. And then once you got Peter through the class, through the connection, then you had like three moving pieces in terms of the team and the demo and Peter. And that all kind of then created this wave. And I remember like being involved in the tail end of some of those fundraising conversations. It was like shooting fish in a barrel, right? You just kind of said like, here's who's investing. You want to be in, you have to decide now. And everyone was just like, yes, whatever, right? Like there was no thinking beyond the social proof and the momentum that had already been established.
that works in a party round environment, and it works when you've got some momentum. And the thing that I would caution there is every business will ultimately end up back at its fundamentals. Like at some point in the future, the market stabilizes, rationalizes, and you can go play those games and go build some momentum and go shoot fish in a barrel. And at some point, it needs to come back to business fundamentals.
Yeah. This is the voting machine versus weighing machine. If you guys have heard that one.
No.
It's like a
No.
like a Warren Buffett aphorism, which is sort of like short term, the market's a voting machine, like what's popular, what's hot, it's all hype based. Long term, it's a weighing machine, which is sort of like fundamentally, what is the
Right.
weight of this thing? And I think that's exactly what you're saying, Mitch, right? It's like over time, you get down to fundamentals of like financial performance, of customer satisfaction, and like willingness to repurchase and things like that. There's
Holding margin and
yeah.
doing the basic fundamentals of your business needs to have the ability to generate profit in excess of costs and expenses.
Others talk about this too. They say, money is a type of poison. That obviously, when you're raising $1 to $3 million, you have to struggle to make some things work. You're gonna have to cludge solutions. You're gonna have to build things yourself. You're not gonna get to hire consultants or agencies. You will have to prove this idea. And too much money, you start seeing strange waste, lack of ability to build capacity inside the company. And those companies correlate with really bad outcomes because they burn through the cash and they haven't actually resiliently built a capacity inside themselves to prototype to the next level to find product market fit.
Yeah, the
Yeah.
foundation's shaky, right? The ability to produce fundamentals isn't there. Or is
I think you see this, and you saw this a little bit around the time that Clinkle was raising money. There were some companies that raised well in excess of where the business was at. But the other environment you see this in is when somebody that's super wealthy or has, some very successful founder goes and funds some business, and you just don't have the fear of going out of business. That is so important to executing and to like that's that evolutionary pressure to stay lean and to deliver results. And if you don't have that and funds are just there, or your founder's a really good fundraiser, again, you end up in a pretty bad spot.
let's talk about your first raise, Mitch, and then we're going to come back to some of these ideas around like creating momentum and fundamentals and things like that. But let's talk about Penny.
So I joined Clinkle and spent a couple of years there. Coming out of that, in the late stages of pivoting and looking at possible acquisitions, we did a little hackathon talking about like maybe we should pivot the company, and we did the hackathon to figure out what might we want to pivot to. One of the ideas coming out of that was a product concept built around this idea that finances are emotional. And so to engage with finances, spreadsheets with red and green on them are not an ideal way for a lot of people to engage with them. And conversation might be a better medium. So we built this little chatbot that would basically take same financial data that mint.com or some sort of spreadsheet would have and synthesize that into a scripted conversation that you would have. Clinkle imploded, a bunch of people left, and coming out of that, I was basically I had latched on to the smartest engineer I've ever worked with, in Alex. I'll spare his last name, but I basically wanted to just spend as much time as I could with this person because they were growing me as an engineer faster than any other tool I knew. And so we continued working on that little hackathon project because we thought it was fun and it was liberating to go work on a product that had no existing bloat to it or anything else. Like the world was our oyster. We started working on that over the course of the summer and just experimenting with how do you get a user, like your first users. And it was fun because every day you were seeing the product improve by 10 or 20%. And by the end of the week, you're like, this is unrecognizable from where it started at the start of the week. And towards as that summer went on, we're like, okay, well, we're not getting paid. We're living in San Francisco. It's not like we did all that well at Clinkle because that imploded without equity value. And so we had this decision to make of do we go fundraise or try to bootstrap the business or just work on it as a hobby project and transition over to like real jobs. And we figured, well, it's going to take a long time to bootstrap this into anything that could actually pay us a reasonable amount of money. So we're really faced with, we work on this as a hobby project while taking on other jobs, or we go fundraise. And we figured, let's just try, see what happens.
What was the like decision process around that? The fundamentals or the bootstrapping option wasn't there, right? In terms of like the economics of it.
The way I would summarize Penny is that we almost fell into starting it as a business. At first, it was just, this is just a product. There's no structure around it, no company, no anything. It's just kind of a fun side project. But then we needed to go sign a deal with Plaid to actually go get bank account information, allow people to put in their credentials and grab bank account information from whatever their accounts were. And that required us to incorporate to go sign that contract. And then there's liability protection and some like basic protections that we wanted. So we went and incorporated using Clerky. And so now we've got a company and it's like, oh, well, the company has, you've got to go decide like who's the CEO and like who's the secretary and what's the equity split between people. And so you have this like conversation about founding a company just to serve the purpose of signing a contract with some banking partner. And then you look at a bootstrapping option and you're like, all right, well, we haven't monetized this product and we're paying costs for these bank connections. And so, yes, maybe we could go bootstrap this, but how many users do we realistically need to get to in order for this to like make enough money that it's compelling? And the answer is like a lot of users, especially since, again, we just hadn't really thought that hard about monetization and didn't really want to because our feeling was incentives are easy to misalign in the financial services space. So again, we kind of went down the path of, well, let's see if we could fundraise. I knew nothing about this. I mean, Neil, I talked to you about how to fundraise and using safes and what a most favored nations clause is, and just all of this random terminology that I learned for the first time doing that. And we just got stupidly lucky. I don't think that was a business that should have been as easy to raise money around as it was, but we had somebody try out the app that turned out to be an angel investor and basically reached out and said, let's meet. And so we met with that person and on the spot, he's like, I'll put in 50K. And we're like, we have no idea how to take that money. Like, we don't know how to fundraise. We don't like, great. So I called you in a panic and was like, how do I accept money?
Did you already decide to raise money at this point, or were you still thinking maybe we'll bootstrap it at this point?
I think we had just started to think about, hey, let's try to raise. And this is long enough ago that my memory is a little fuzzy. And we went into that conversation. He heard what he wanted to hear about the pitch. I think the pitch was terrible. It wasn't even a pitch. We didn't have a slide deck. It was just a conversation where we met with him. And he's like, great, I'm going to put in 50K. And then he introduced us to Social Capital, which ended up, we did one meeting there. And actually that was a more proper process where like, I think we put together some slides and Rob helped design the slides. And you both had a big role to play here, actually, it turns out. So we did a pitch with the partner who we had been introduced to, and he got really excited. We just pattern matched. It turns out he had a thesis around this, really was sad that he missed out on Digit, if I remember correctly, which was basically a savings app that was text-based and was looking for another company similar. It was two people that had worked together, one of them from Stanford, coming out of a payments company that had been disastrous. And so we learned a lot of lessons from that and then pitched the partnership. And I think that was honestly more of a formality because the person that we spoke to originally had enough clout and it was a small enough check. It was a $1 million check that I negotiated up to 1.2 million, and that was it.
So you went 2 for 2. You got your first one was inbound, and you closed that one
Yeah.
in conversation, and then that led to your second pitch, which you also closed after a second
So
conversation.
we did do some other pitching around this. And there was, I honestly forget how we got connected to some of these investors, like who the connections were, but we ended up with basically two angel investors each in at 50K, and then the 1.2 million from social capital.
Do you remember
And,
any of the other pitches, like not necessarily who they were, but like what the conversations were like or how the pitches went?
yeah, I think that so we had a product demo and we just showed the product demo, and it was the real version. We went with the real version rather than a scripted one. And it worked out well that people were like, again, it's part of that. It's so easy when you're given a canvas like that to then go extrapolate it. So we got to the point in the conversation where it was, oh, could you also do X? And you want your answer to be absolutely, we could do X. That's an excellent idea that we had never thought about. Like, this company is going to be huge. And we had a few of those conversations. Other people were more correctly probing on some of the, like, how do you make money on this? And will the unit economics work out? How do you go acquire users? Like those sorts of questions. And we didn't have the most compelling answers to those things because we hadn't ourselves put a tremendous amount of thought into it. Yeah.
So this is all pre-pandemic. It's happening in person in San Francisco.
Oh yeah.
In cute
Yeah.
coffee houses with
Yes.
these angels.
Yeah, this is like next to South Park, and having conversations there and having them in downtown San Francisco. This is like 2015, maybe.
The good old days.
Good old days. And again, we got lucky. We pattern matched against what somebody was looking for, and had, I think, almost accidentally stumbled on a canvas that makes the storytelling so easy here of like, it's scripted chat. You could do anything you want with this. And that got a lot of people pretty excited.
So San Francisco is a magical place in this way. It sort of manufactures luck for startups. I remember you needed Plaid access, and we were at the hackathon. We just walked over to the Plaid office. It was 5 blocks away. Turns out everything is in San Francisco. The money, these cute places, your next tire, they're all there, right?
And then Plaid's early on, and they're like, look, we want the companies building off of our platform to be successful. Here's some intros to investors that you should think about talking to. And it was just kind of a lot of that serendipity where you start a conversation and other founders will introduce you to people, or other businesses will.
What's your advice for everyone who's not living in San Francisco? Because there's only 800K, whatever, people there. All the founders starting elsewhere. How do you have these conversations?
Well, I think that the market has also shifted. The environment for raising money looks very different today than I think it did in 2015. There's more money floating around. Seed rounds have gotten much bigger. There's like friends and family rounds. Expectations have shifted on amount of progress that you want to deliver. And I think a lot of my advice is dated at this point. So I have now raised money for a seed round for a software company back in 2015. And then I've raised money for a hardware company more recently. And so I can speak on some of the hardware aspects of this, but I'm not sure my advice carries much water these days for the software side of this in terms of what investors are looking for, how to get in touch.
So
But
modest, Mitchell.
The most modest.
I think the strategy I would use for anyone, independent of where you are, is go talk to other founders or other people at companies. Like, don't start with investors. It's the worst place to start. Go share your pitch with friends, then try to ask them who they know that might be interested in the idea or giving feedback on the idea. Constantly be asking for feedback. And that's how you build a little bit of upfront momentum. Because when you get to the end of that pitch and people are starting to say, I think you should go talk to X person, that's a good sign. And when they start saying, like, I'm sold, are you taking money, or you should definitely go pitch this person, that's a really good sign. And if you do that with enough people and you're like spreading out, where you start with one node and then you jump to 3 more conversations and those turn into 9 more, like, that's what you want to see. And you get to a point where you've got a moderately packed schedule of these conversations. And even if none of them are about giving you money directly, when you then say back to those 20 or 30 people that you've had, we're going to go kick off a fundraise, is there anyone like you can introduce us to? that carries more weight and tends to in parallel jumpstart a bunch of conversations.
I think
I
there's a
imagine.
thing about having built something, right? Like with Clinkle was a great demo. With Penny, you had a working product with users, even though there's probably no question at that point about your and Alex's ability to build whatever you were going to build. You had already built something, you had already gotten some users, and you could show someone something there. But you hadn't gone so far where the whole conversation was about economics and user acquisition performance and retrospective analysis of those things. It was more about what's possible here, and here's more than proof of concept.
Yeah, and this is where I come back to. I think the benchmarks you're being judged by have shifted. But back then, I think we had 500 users, maybe 1,000. And we had a growth chart that looked promising because we were going from like 5 to 10 to 500 to in excess of 1,000. And a retention chart that looked promising that was like could only go out 6 or 8 weeks because that's how long we had users. But I think the rigor of how we were thinking about it and some of the core metrics that we were presenting, it's less that core metrics themselves were that compelling and more about the thought, the how we're approaching this as founders. Seed bets are very much still a bet on founders. And that applied in spades at when we raised money for ARC, that it was very much a bet on founders.
How did you get the first 500 users?
So the first probably 50 were just friends and posting on Facebook and LinkedIn and whatever. And then the first 500 was us posting on Hacker News and Reddit and doing a little bit of blogging to try to convince somebody to sign up. I wrote a blog post on how to incorporate a company. And throughout that, I had like links to
Nice.
Penny and people liked the blog post and then also signed up for the product. I have a blog post on how we acquired our first 500 users, and then that itself drove additional growth.
Yeah, so you didn't buy users for the first 500. It was just
No.
all the kind of earned media and like just building credibility.
Yeah, and that transitions into what I think our biggest mistake at Penny was that it was not a company that I actually think was well suited to venture capital, or at least our mentality as founders were not well suited to venture capital. We raised that money and we were so proud of how thrifty we were with deploying it. We were like, we are super capital efficient. We're going to make a bunch of progress with small amounts of spend. We're going to take our time figuring out and exhausting every way that we could acquire users without paying for them. And we're going to keep our team really lean. So it's going to be a really small team. And again, my analogy for venture capital is generally speaking, people want you to strap yourself to a rocket, whether or not it goes up. They do not want to see you build a plane or a glider or anything else like that, because it's such a power law distribution that what they're looking to do is deploy the capital and over a period of 7 to maybe 10 years, have at least one of those things go generate a 100x or 1,000x return. And they're looking for companies that can go do that. And if you come in and say, you give us money, we're barely going to spend it, and we're going to like stay really lean for a really long time, like that's not actually what you want.
You had investors breathing down your neck at Penny asking you, where's the team? Where's the office? Where's the expansion? Okay.
No, it was kind of hands off. Like we
Okay.
didn't get a lot of attention. And I think we could have benefited from more attention and more coaching and more like, hey, here's a little bit more pressure to move faster. I think we trended in the direction of, hey, I'm just not going to pay that much attention here because you're still figuring it out. And actually, towards the end, we really did start to figure it out. Our growth really started to accelerate and we started hitting on things that looked really promising, and we started making money as a business, and like all of these things started clicking into place, but it took us 2 years of doing that to get there.
So why exit?
Because I think we had this realization that what we were building was more of a product than it was a business. Like if you go back to the founding story of Penny, it was, this is a really cool product and we just want to keep working on it. And let's try to now invent a business around that. And like, let's try to slap on monetization on top of that. And the pitch from Credit Karma was, why don't we just take the concern about building the business model off of your plate? You get to go focus on this product that you really love, which is based on financial literacy and getting people to engage with their finances. And we will give you insane scale to the tune of 100 million people. It feeds back into the product that people will engage with our product more, and our engine that generates revenue will take off because of this. And that was a really compelling pitch. Again, that I think we just had this growing realization of Penny was probably not the right fit for venture capital. Now, if we had started Penny, say last year, I think it'd be a fantastic fit for venture capital because it's really a product that lends itself to generative AI and some of these like conversational engines.
Did you guys raise
So,
a second round with Penny, or was it just that first one?
We did the seed round and then we went through Y Combinator, which is kind of the reverse order that you typically see. The Y Combinator was really that accelerant that got us thinking in more of a venture capital mentality.
Did you end up raising after Y Combinator?
No, I think we brought on another couple angel investors, but still had most of our money in. And so we started a fundraising process later that year where we actually went out to go raise a Series A, and that's around the time that the acquisition process also kicked off.
so it's 2 years of constant inbound people asking if they can give you money.
No.
Okay. You mentioned that it was, 2 years until you exited, but during this time you raised from 4 angels, your initial seed round, and then you also had Y Combinator. It's a lot of fundraising activity.
I think it was actually closer to 3 years end to end. And the Y Combinator and the other angels were like basically stacked together. The angels and the initial seed round were stacked together. So it was really like two fundraising events that I think we went through, and then the acquisition.
And the first one was like 3 meetings total. So it was pretty,
It was probably like, I don't know, 5 to 10.
I'm just kidding.
Not sufficient to trust us with. I mean, we were really good stewards of the money, but again, that's not actually what you want in venture capital. And so I think that's probably a good transition into go do the tour at Credit Karma and start thinking about what I want to do next. And I was playing around with a couple different ideas, but electric boats was the one that really jumped out to me and my co-founder Ryan as like, this makes a lot of sense. There's a very clear why now answer. Why couldn't this have existed years ago? Why can it exist today? And the answer there is really the automotive industry and how much R&D dollars were flowing into making cars electric, which we just are beneficiaries of. And I did that same thing, whereas the process of vetting this idea, I just started talking to people about it. I think there's this hilarious pattern of people being like, you need to sign an NDA to, like, this was a Clinkle pattern, sign an NDA to hear anything about this idea, and it's super secretive. And my deep feeling here is that ideas are cheap and execution is the hard part. And so you should feel very comfortable talking to anyone about any of your ideas, because the hard part is actually going and executing against it. So I was very open about, this is what we want to do. We're thinking about electric boats, and here's our thesis on it, and having all these conversations around it. And Anish, who ended up leading our seed round, said, look, I know nothing about boats, but I know that you work really hard, and your co-founder is from SpaceX and clearly has an incredible resume. And I want to take a bet on the two of you. So like, why don't you pitch us this idea? Again, completely offbeat for him as an investment, and a testament to Andreessen Horowitz for even allowing their partners the liberty to go invest very off thesis like this. So we pitched him, and he's like, I don't know if this is a good idea, but like, here's money because I really think that you two are a strong founder team. And we see enough potential here that this could be something. And I credit him for taking an early bet on us, because I think a lot of people thought he was crazy early on, and whether or not that turns into a massive win for him, I think he has been vindicated in some respects, that like there's some momentum and legs to the idea that we had.
Did you plan to just build something with Ryan as the first priority, or was it like, I want to build electric boats and Ryan's the best person to work with on it?
No, it was more, I want to work with Ryan. What ideas can we go pursue together? And this was us being deliberate. Whereas with Penny, we kind of rolled into it, and it was just like, the next logical step here is we either get a job or fundraise, and we've got to build a business around this product. With ARC, it was very much, we have this idea. This is the type of business that you want to go fuel with venture capital, where your conviction is really high, where you're taking little market risk and predominantly execution risk, and you actually go do this, where the capital expenses are upfront are pretty high, and where you've got to go build a team well in advance of delivering a product to market. Like, that is exactly what venture capital is for. And if you're able to go do that, you build a really defensible business that can be really large, that can pay back these early investors in a really compelling way. So it was work with Ryan, vet some ideas. Electric boats came out of that. And then how do we want to go fund this? Absolutely, venture capital is the right fit. And this is actually the right application of venture capital.
And this was also like a situation where you may have been raising, or at least you were pretty early in the process if you were raising, or maybe you weren't even raising, you were just kind of socializing the idea, but very quickly got to an offer similar to Penny.
Yes. We were socializing the idea. Now, I was socializing it in expectation or hopes that we would kick off a fundraising process. But I was pleasantly surprised by, again, Anisha's willingness to go, like, he actively pulled. And I think we benefited again from market timing, that it was just a hot market. And so he's like, look, these are two super talented founders. We should at least hear them out. And then they heard the pitch and they said, this sounds great. They gave us a term sheet. We were thrilled. We told them, like, look, if you could hit these, what we consider to be pretty reasonable terms, we're not going to try to shop this around. We're not going to go run a process around it. Like, you as a firm are somebody that we would be thrilled to partner with. And you as an individual are somebody we want to partner with. So we signed the term sheet. And then we had allocated a little bit of space for other investors. And we went and did those pitches. And a lot like Clinkle, I mean, when Andreessen is leading around, there are a lot of people that are interested and excited and signing up to also just jump in. And they use A16Z's like diligence or check as a proxy for their own diligence process, so they can make decisions pretty quickly.
So at this stage, the pitch is verbal? Is it a set of slides?
It was verbal early on, and then when it was like, hey, you need to come pitch another partner, and then we need to, I think there was one more partner pitch after that. He's like, you should put together some slides. And so we put together some very ugly slides.
That's the way.
And
they weren't the best designed.
Yeah, I mean, but I think that's okay. It didn't matter because like it focused on the idea, and our pitch is still like execution.
Yeah.
This idea is obvious and it's just execution. And what you will get from us is we are going to be execution machines. We will work around the clock to go build boats and to drive these really fast feedback loops. And we did.
Did your investors need to see the operation? You have a big warehouse in LA. You do a lot of this production stuff. Did they need to see that before the term sheet?
At the seed stage, we were still employed at our other jobs. So these conversations were like happening like so quickly that we were trying to give notice at work, and like it was kind of happening in parallel. And we said, look, we're not taking any of your money until we are like out from our existing companies. And so we kind of set a close date beyond, like we gave notice before signing anything, and then set a close date for after we were both out at our jobs. And then basically the day after we were out, we were running on ARC. And we had nothing then. We didn't have a physical space. We basically had napkin level sketching of a boat. It was really still the idea of just electric boats make sense. Somebody should go do this. We think we're the team that can go do it. And a thesis that the founding team that you want are people that can build a lightweight hull in order to offset the weight of the battery pack, which is where the SpaceX like background came into play. Of when you squint, the nose cone of a rocket is kind of similar to the hull of a boat. And then we hired our first few people, and the pace that we operated at, the way that we deployed capital was entirely different from Penny. We were way more aggressive on timelines and willing to spend money to move really quickly. And again, that's because we just had such high conviction that this product can and should exist, and we're not taking a lot of market risk. We don't need to like do this dance to find product market fit. We need to go build the product.
So now that it's your second time around accepting venture money, did you have the exit conversation with your co-founder before you took the money?
In terms of like, what do we want this to be? When
Exactly.
I think we like loosely talked about it. So Ryan and I are good friends and have spent a lot of time historically, and obviously spent a ton of time at our talking about these things. And we're both aligned that this company should be public. Like that should be the exit path. It would take a pretty irrational acquisition offer to get us to stop working on this, because it's really fun. It's motivating and challenging. It has a really compelling mission. Like, why exit that except at like kind of a public level?
I'm sure Andreessen was happy to hear that.
That's the right
I,
answer for a venture investor.
yeah,
That is
exactly. And this was one of those learnings again that I like at Penny, it was like, again, very capital efficient. And that's not to knock what we did there. I think we built a really awesome product and we had a successful outcome, but it just like wasn't an incredible fit for venture
yeah.
capital. Whereas ARC very much was, and our mentality of like, we are going to go focus on execution and be relentless about it. And we are going to deploy capital in our pursuit of that. And we're going to go staff up a team to do this. And like, we're not going to stop until we're the biggest marine company out there. Like that sort of mentality is a much better fit for venture capital.
I remember visiting your first office, and it's probably one of the coolest tech like tour experiences I've ever had because you had a giant, I don't know, 20,000 foot square feet warehouse. You had at least two hulls. One of them was being actively like welded. The other one was like, the investors can touch this one. We don't really care about it, or it's already done. We were there with, but by coincidence, there were like two other people doing the tour with me, one of whom was
Yeah.
from Clarion Capital, who was like Peter Thiel's super sharp assistant associate man asking
Yeah.
all these penetrating questions about battery packs. And I was like, wow, this coming from the world of software, this seems so professional. You got like a locker, 15 square feet full of engineers just packed. Hardware people like scribbling on pieces of paper, like some people like literally leaning over each other to
Yeah.
like point and gesture at diagrams. I was like, this is another level. Usually we just, fucking downloaded a library from GitHub and we have a website. And then like, yeah, there's a conversation over coffee to get some money. This is some real engineering.
I think hardware gets a bad rap for being hard, and it is incredibly hard. But I think the moat that you can build if you're willing to put in the time and the effort and stay focused and stay capital efficient it's defensible because the learnings compound over time. Like
Sure.
the anecdote I give is Tesla up until very recently was over 2/3 of the market share for electric vehicles. That's not because other people aren't trying at that point. It's because they just compound the advantages in terms of your battery supply chain or the learnings that you have on how to test and qualify and service high voltage components and the software system that you have in place. Like all of these things just compound over time. So it's a lot of really hard work and it's high stakes because, working capital can kind of get out of balance pretty quickly if you're not careful. But if you put in the work, if you keep your head down, if you focus on execution, if you focus on execution, if you focus on execution day in and day out, then you can build that moat.
There's also something interesting about like the amortization of the capex, right? Like the marginal boat for you guys at some point is just impossible for anyone to compete with who's trying to replicate what you're doing because they have to amortize that whole thing, right? Like your marginal cost keeps going down over time in a way that's true for software as well, even though it's not as extreme as, the copy paste analogy.
If you look at software today, like, I don't know, Snapchat is a good example where their moat is really through their network. The technology itself isn't that hard to replicate these days. You could have two people and, I don't know, 2 months, and you probably have a pretty close clone of Snapchat. That's just less true in hardware, that there's really no shortcuts on getting these things to work. You can't just, like, you could take a team of some of the brightest engineers at Tesla and say, go make an electric, I don't know, snowmobile or something. And it's just a different enough problem that you're going to have to go through learning cycles. And it might take them fewer learning cycles, but they're not going to get a perfect product out the door on day one. Production is way too hard for that. It's way too big of a coordination problem. The context that you're operating in looks very different. The funding that you have, the resources that you have, it's all different. And so even if you're bringing a lot of that experience to bear, you still need to go through that process of feedback or like kind of learning cycles. And so we're 3.5 years into ARC. If somebody wants to come compete with us, and that's 3.5 years of like testing boats at 10 p.m. on a Friday night sort of mentality, not, I don't know, 9 to 5s. And if you want to come compete with us, you've got to go start where we started maybe you get to start a little bit further forward because the market's moved or you've got better access to components or something, but not much farther forward than that. And then you've got to go build a team and get the capital and go do that sprint that we did. And meanwhile, we are continuing to sprint. So we're just kind of pulling further ahead and trying to compound these advantages and compound the learnings. And our software telemetry system is getting more and more robust and allowing us to move faster and drive our costs down. And it's a defensible moat for good reason.
Yeah, it seems like the truism of like speed being a source of defensibility is even more true in hardware, where maybe you have other forms of defensibility you don't have in software, but speed is still a huge asset. If you can keep that flywheel spinning, you can keep picking up more and more of an advantage versus your competitors.
I think that's true. And also in hardware, where I mean, like the same fundamental equation applies in software, but I think it's more acute or more top of mind in hardware, that hardware tends to have a big upfront investment that you need to make. And then you've got pretty high operating costs just to manufacture something. You've got to have your manufacturing engineers and the people building the parts and your people servicing them once they get delivered. And like it's kind of a high overhead business. And so that's kind of the upfront cost, your like R&D cost, and then your operating costs. And that needs to be balanced out by how much money you make, which is a function of how much profit are you making per unit and how many units are you doing. So you kind of can go like point by point in that equation, and you start with upfront R&D costs. Well, the way to keep that down is to run really lean. It's to focus on how do you learn as fast as possible in a hardware space? How do you treat hardware kind of like you treat software prototyping? And it's hard to accumulate too much cost if you just move really fast. It's easy to accumulate a lot of costs over the course of a 5-year development process. It's harder to do that if you condense that into 2 years, because you have fewer opportunities to spend money. Then you look at the operating costs and you're like, all right, run lean. Like everyone should be feeling a little bit underwater. That's a healthy feeling to have, because it means you're only prioritizing the highest priority things, the most impactful things. And again, doing things with tools or with software to try to get a lot of leverage out of the people that you do have. And then on the margin side, it's okay, how do you drive high margins? Well, it starts with just making a fantastic product that gives you some pricing power to be able to charge a lot more than it costs you to make. And then the manufacturing part is just hard. And like that's the driving unit volumes up. Is there are no shortcuts. Manufacturing is hard. Like Tesla, as good as they went through manufacturing hell for the Model 3 and the Model Y, and Cybertruck struggles with manufacturing. Like it's hard. You really just can't take shortcuts here.
Let's leave the hard world of hardware behind and go back to fundraising for a second. You had the first round of Penny be kind of fast and I don't want to say easy, but not as involved. The second time you raised here with ARC, you raised the first round, also seemed like it went pretty quick. How about the other rounds for ARC? What were those like?
We did, after we announced the ARC 1, which is our first product that we brought to market, there was a lot of enthusiasm from people that like saw the news. And so we got some inbound of, particularly on the celebrity side, of people seeming interested in putting like, taking an equity stake in ARC. So we did kind of this celebrity, you could almost call it a party round in some respects. It made sense for ARC because we are a lifestyle. Like you need cars. Boats are really about the lifestyle and enjoyment and a brand that you're building. So it made sense to work with people that are world-class at building brands. So we did this round that brought in some celebrity investors. As part of that, we also got introduced to some potential angel or like strategic investors. One of those strategic investors introduced us to a fund that we had never heard of before, Eclipse. And I had what I think was one of the best first conversations with an investor in that meeting that I took with Eclipse. This guy, Lior, that is, if you've ever met him, is just intense and matches our level of intensity and understands that building one of something is actually pretty easy and building a lot of something is really hard. And so it was just this, like, I don't need to explain the challenge that we're up against here. You get it. And we had a good kickoff conversation. And then he's like, look, when we get interested in something, we don't wait around. So I think like 2 or 3 days later, he sent somebody down, the person that's now on our board, Greg Reichow, for a visit. And he walked through that factory or warehouse that Rob mentioned, saw oversized bathtub of a boat that was kind of our prototype or development vehicle, and the makings of our first aesthetically finished boat. That aesthetically finished boat didn't even work at the time, but he looked at it and he's like, I can extrapolate here. This is the story. Like, I understand the story. I'm going to give you credit for the progress that you're going to make over the next 6 months because it's going to be painful. You're going to face all these different setbacks, but I know you're going to work through them. So they preempted our Series A, and I could not have been more happy to have taken their money because they've been a fantastic partner, really operationally focused.
Have you gotten better at pitching, do you think?
I think I understand what I'm supposed to be doing in pitching. I have often been accused of being too humble or boring or bland in a pitch.
No.
And probably by both of you, actually.
I was going to say, I feel like I've said that before.
Yeah.
At the same time, you raised 3 rounds now at this point in time, none of which you were actively raising or like struggling to raise. It just has happened fairly fortuitously, it seems like 3 times in a row.
Yeah. We were benefactor of the times. Like when we raised our Series A, it was October, November of 2021, right as the market was really peaking. I think the Series B was right at the bottom of the fundraising market, and one that I actually did invest a lot of time into the storytelling component. And that was, I think, the first time that I've taken my cumulative years of experience and really brought it to bear on a pitch, on running a process, on telling our story to investors in a way that shapes this narrative, like hooks them with one of the early slides and hits them with like a proof point of this is how much money it took us to deliver our first vehicle to a paying customer. This is how long it took. Like hardware is not as expensive. Like don't think of us like an automotive company. We are not an automotive company. So that Series B was probably the hardest raise that we did.
It sounds like you have a 50% conversion rate roughly between I'm talking to you, I'm flirting with you just as like an angel, and I'm actually going to take some money from you.
It's definitely not that high. We got a lot more no's at the Series A for Penny. I mean, we got to like further meetings with other people, but the funnel was much more of a filtered.
All right, well, lay it on us. What's the conversion rate for Penny and then for ARC?
I truly do not remember the conversion rate for Penny, but I mean, the Series A was
Like
tough, and I'm not
how
sure.
many investors did you talk to for the Series A for Penny? At least 20, 30?
Yeah, I'd say like 20 plus investors. And I don't know that we would. I mean, it's hard to go back in time and say what would have happened if we didn't go down the path of the acquisition. But
Did you guys seek it out? Did they come to you? Like, how did that acquisition happen?
no, so the acquisition was, I think we got some coverage in TechCrunch or something like that. And the person that was leading up product at Credit Karma at the time reached out and just said, hey, I think this is an awesome product. I'd love to chat. And pitched us on, I think this was right after the seed round, maybe pitched us on like a higher sort of thing. We're like, look, we're having way too much fun with this. We don't want to walk away from this. Like that's compelling, but we're invested now. And then we just met every quarter. And that was, I think, smart of me and smart of him to invest in that relationship over time. Like I would follow up with him every once in a while to just ask for advice, ask for what is some of the data that Credit Karma had seen on some of these conversion rates, or how do you think about as we step into paid advertising, how does that work out? Those sorts of questions. And then, yeah, I tipped him off that we were about to start a Series A process. And he's like, okay, it's now or never. Like, you need to come in and pitch us because if you go close that Series A round, like you're not going to get an acquisition offer from us. So let's talk about what this could actually look like. And it was a really slow process. And I think as we went along, we got really excited about the acquisition because it just made a lot of sense. And again, was kind of this what I felt like was probably a more natural outcome for the company that you make it a product inside of a bigger business.
I remember you guys caring about like actually reaching users and wanting them to feel like they were more in power with their finances. And it did seem like the acquisition was really aligned with that, where it's like, look, you can build it on your own. It's going to take you a long time to reach this many users, or you can just come into Credit Karma. And now all of a sudden you can reach a ton of users very quickly and have an impact on people's lives.
Yeah, Alex and I were both really mission driven with that company, that we just got the parts of the day that we liked most were, responding to support tickets from people, or having somebody submit a feature request and us coding up that feature request and having it on their phone later that day. Like that was
It's good stuff.
those were kind of the things that got us most motivated. And we love these like in-depth conversations where you would take somebody through this whole path of how should I interpret some of these financial things or bank fees, and highlighting bank fees and opportunities to not have bank fees. And it was really motivating from that perspective. And so then the pitch to say, don't worry about trying to monetize the heck out of this thing and squeeze every dollar you can from people. Really just focus on the educational content that gets you so excited. Like, go write this conversation about people's credit scores and how to interpret them and what they can do to improve them. And like, you get to go do that, and the rest of the business will take care of itself. And when you build that relationship through conversation, the pitch for them was, when you build that relationship through conversation, conversion rates go through the roof.
Mm-hmm.
When you're like, look, the reason that I'm giving you a recommendation for this neobank or for this, other checking account is that they don't have fees for people below this amount. And when you give that recommendation on your 7th conversation with somebody, rather than your very first one, or rather than as a display ad, conversion rates were just sky high. People are like, this makes sense. You've kind of built me up to this point with a story.
Yeah, I think that's a reason why a lot of folks sell is distribution. And it's not just about the financial aspect of distribution. It's about seeing their product in the hands of a lot more customers, a lot more users. Let's fast forward back to ARC, to the Series B, the bottom of the market. This is maybe the first time you faced some adversity in fundraising, it sounds like. What was that experience like?
So I took the playbook that I recommended at the start of this, which is I started prepping materials. Everyone knew, at the investor level, the board level, internally, we all knew this was going to be tough, because it's probably the worst fundraising market that we had seen in the past dozen plus years. And so we needed to be perfect in the pitch to make sure that we got the money that we needed to go be successful. And so we started prepping materials, and then started sketching the outline of a story and what are the proof points that we want to show, and all these kind of internal prep materials that we started pulling together. And then I started having a bunch of conversations with friendly people, with first our investors or friends that were founders or whomever else. And I just tried to sketch out that pitch over and over and over again until it felt like it was starting to click. And once it felt like it was starting to click, then I pivoted over to we are kicking our process off. I got intros to every investor I could and just started taking those pitch meetings. And that process ended up coming together really quickly, in part because of internal conviction from our investors. Like our existing investors had high conviction. And I think that really helped catalyze around. And the difference between success and failure is a knife's edge in a market like that. So if you get the momentum, you run with it, and you just lean into that momentum and close around as quickly as you can. And so our round ended up coming together in 2 or 3 weeks. Again, that was very much driven by conviction from our existing investors to want to go put more money in. And that also excited external investors, that the people that knew the most about the company were willing to put their checkbooks to work.
Of all the people I know who've raised $100 million or more, you have to be the most humble, I think, out of everyone I've ever met. Especially given the fact that even in your toughest raise, it was a 2 to 3 week process from the official start. Obviously, there was lead time of preparing.
Yes, but the reason for that humility is because I don't think you can correctly attribute, I don't think anyone can correctly attribute fundraising success to me or my pitch. If we had not had the execution to back that up, we would be out of business. And the thing that we fundraised on was, we delivered a boat to a paying customer. We went zero, absolutely nothing other than an idea of electric boats to delivering a boat to paying customer in under 24 months. And that was obscene. And we did it without spending a ton of money. And we had this vision for this is the next product that we plan to bring to market. And that's execution. I am fundraising for this company off the back of execution. And in some ways, that market was played to my strengths better, because it's not about hype and how this AI thing is going to be worth $10 trillion, which is kind of a tough story to believe. It's just evaluate us as a business, evaluate us on our execution. And like, if you monitor us for a long enough period of time, you will gain conviction in us as a company and our ability to go deliver. And you've got to put blinders on because there's hype going around all over. I mean, like at one point, like crypto and NFTs were taking off, and it was tough to be this company that's working really hard and keeping your head down and trying to build a business, and see this company that's existed for 16 minutes go raise at a $200 million valuation. And you're like, what's going on? But then you put your blinders on and you just focus on what you can control, which is your own execution. Those hype cycles fade and those companies struggle because they eventually have to regress to their fundamentals as a business. And then the next one comes up. But if you just stay focused on execution, like that's ultimately what you'll be judged on as a business.
I appreciate you making the time and sharing your experiences. And we could do this for a few more hours and it'll still be fun.
Nice catching up with both of you. Thanks for having me.
Thanks, Mitch. Yeah.
All right. That's it.
Thanks again for tuning in to this episode of Money Moves. If you learned something new or just loved this episode, click below to subscribe. See you next week.